Strategically investing your crypto into retirement accounts can save you from losing over 50% of your entire portfolio to taxes upon distribution. Doing it wrong can cost you over 50% of your portfolio. But first, let me give you 2 reasons why a crypto retirement account is an extremely attractive strategy. Number 1, because you already invest in crypto if you're watching this video. And number 2, because Bitcoin has grown on average over 200% per year since its creation and over 60% per year over the last 10 years. Now, realistically, probably won't keep growing at that rate, but let's model out compared to the average stock market returns, 1 Bitcoin worth about $108,000, today growing at the historical average rate of return of stocks, 9%, 25 years from now would become $1 million. 10%. So that's 10 times more at 20% rate of return than 9%. So that's why crypto, and having that $10 million completely tax-free is why to do it in a retirement account. So a crypto retirement account is the right strategy. Many people know this. But a crypto retirement account requires the right execution, and that's the part that most people don't realize. I see these disastrous mistakes every day as a crypto CPA to hundreds of investors and as a resident tax advisor with Altcoin Pro. Within the group, we have a crypto tax mastery course teaching investors how to protect their crypto from IRS audits and avoid losing a massive percentage of their gains to the IRS every year. So today, we're going to talk about how to secure your long-term future through retirement accounts and how to avoid these 5 mistakes investors make that can blow this whole thing up. I'll simplify these complex and boring topics that are mastered by the wealthy. And if you need professional help implementing these concepts like the elite, there's a link to a call with me in the description below. First, let's start by explaining what a crypto retirement account really is. It's just a self-directed IRA or 401k that allows you to invest in crypto directly instead of being limited to the stocks or funds offered by your normal retirement account custodian. The taxation is the exact same as a normal retirement account. Traditional retirement contributions are deductible. Roth contributions are not. Both traditional and Roth gains are deferred until distribution, and Roth distributions are tax-free, whereas traditional distributions are taxed as ordinary income. Put another way, traditional versus Roth are just opposite tax benefits on contribution or distribution. Both get tax-deferred gains. So in a self-directed account, you get access to way more options of where to invest, but it moves the compliance requirements from the custodian like Fidelity, Charles Schwab, Vanguard to you. You're the custodian now. And these compliance requirements have massively harmful penalties for not properly fulfilling. So if you're going to go for the 60% historical annual Bitcoin return on your retirement account, it's worth knowing these compliance basics. So there's 2 main parts of the tax code that control how this works. Section 408 defines what an IRA is and what it can hold. It's a trust held by a custodian or trustee. Usually that's your large brokerages, but it can be you. But there's a catch if you're that trustee. You can't control those assets yourself. Your retirement funds have to be separate from you or it's no longer considered a retirement account. We'll talk about that more later. Section 4975 lists all the prohibited transactions, which are basically things you're not allowed to do with your IRA funds. We'll go deeper on that too shortly. And if you violate these rules, Section 408E2 says your entire IRA is treated like you cash it out on January 1 of that year. That means the full amount becomes taxable income. And if you're under 59.5, you also owe a 10% early withdrawal penalty. So let's explain those previously mentioned sections while going into the 5 grave mistakes that could lead to violating these rules and owing half of your portfolio in penalty. Mistake 1, holding collectibles or NFTs. Because under Section 408M, IRAs can't hold collectibles like artwork, rugs, antiques, gems, or certain coins. In the crypto world, that means NFTs that represent art or collectibles are off limits. In IRS Notice 2023-27, the IRS even said that NFTs tied to collectible assets could be treated as prohibited collectibles. So if you buy a Bored Ape or a tokenized piece of art inside your IRA, that's a prohibited asset. Nearly all of the crypto assets wouldn't qualify as collectible, but avoid the NFTs in your retirement account. Mistake 2, using self-custody or personal wallets. This is the #1 mistake I see people make. Under Section 408A, your IRA must be a trust held by a custodian. If you personally hold the private keys, you've taken control of the asset, and the IRS treats that as a distribution. This has happened before. McNulty versus Commissioner, a 2021 tax court case. In that case, the taxpayer used an IRA-owned LLC to buy gold coins, but then stored them at home. And the court said that was personal possession, and the entire IRA was disqualified. So if you move your IRA crypto to a hardware wallet like a Ledger or to MetaMask, it's the same problem. You're holding your own retirement assets. Watch out. Now I know what a lot of people are thinking. I don't trust centralized exchanges. Can I really not just hold my own keys somewhere safe? Unfortunately, no. The moment you hold your own private keys, the IRS considers that constructive receipt. In other words, they treat it like you took the assets as a distribution. The good news is you don't have to sacrifice security to stay compliant. You can use institutional grade custody companies like Kingdom Trust, BitGo Trust, or Anchorage Digital. They're qualified custodians under federal rules, and they use cold storage and multi-signature controls that are actually safer than most personal wallets. Problem solved. Mistake 3, DeFi, staking, and yield farming. DeFi and staking are awesome, but they arguably don't belong inside an IRA. At least they're a little risky in retirement accounts due to lack of regulatory clarity. So when you stake tokens, provide liquidity, or yield farm, you're actively using those assets to generate income. That may count as furnishing a service under Section 4975 C1C, and it can also create a type of business income that triggers unrelated business taxable income, UBIT. And it can also create a type of business income that triggers unrelated business income tax, UBIT, under sections 511 through 514. Now, the IRS hasn't given clear guidance on DeFi yet, but based on how these laws work and the case law we currently have available, staking or yield farming with IRA assets is a serious risk. Even if it's not a full prohibited transaction, the income could still be taxed at trust rates, up to 37%. So inside a retirement account, DeFi activity is just sketchy until the IRS clarifies the rules. Mistake 4, using leverage or borrowing money. This one catches a lot of smart investors off guard. Under Section 4975 C1B, your IRA can't lend money to, borrow from, or personally guarantee any loan involving you, your family, or a business you control. That part's straightforward. You can't personally back your IRA's investments. But the real danger is UDFI, unrelated debt financed income, under sections 511 through 514. That rule says if your IRA uses borrowed money to buy or trade an investment, part of your profits become taxable even inside the IRA. So if your crypto IRA trades on margin, borrows stablecoins, or uses any kind of leverage, that portion of your gains is immediately subject to tax at the trust tax rates, which goes up to 37%. For example, let's say your IRA invests $100,000 and borrows another $50,000 to trade. 1/3 of your capital came from debt, so 1/3 of your profits are taxable. If you make $30,000 in gains, $10,000 is UDFI and taxed at 37%. It's that $3,700 surprise tax bill you probably weren't expecting. And if you personally guarantee that loan or margin account, that's a prohibited transaction. The entire IRA could be disqualified, just like in Pete versus Commissioner. The bottom line, borrowing, leverage, or margin is always taxable UDFI. Personal guarantees or credit, prohibited transaction. Even DeFi lending and collateralized trades can trigger these rules. The safest path is simple. Keep your crypto IRA debt-free. Use only cash inside the account and avoid margin, leverage, or borrowing entirely. Mistake 5, self-dealing in related parties. Section 4975 C1A through F bans transactions between your IRA and disqualified persons. That includes you, your spouse, your parents, your children, and any company you control. You can't sell to your IRA, buy from it, or invest your IRA into your own or your family's business. If your IRA buys tokens from your personal wallet, that's a prohibited transaction. If your IRA invests in your spouse's startup, that's another one. Any personal or family benefit is off limits. Here's an example of what happens if you violate any of these rules. Under Section 408E2, your IRA is immediately disqualified. That means the full account value is treated as a withdrawal on January 1st of that year. If your account had $200,000, that's $200,000 added to your taxable income. At a 32% federal rate, that's $64,000 in taxes. And if you're under 59.5, you add a 10% penalty. That's another $20,000. So just one of these mistakes could cost you $84,000, 40% of your entire portfolio or more. But here's the summarized steps of how to protect yourself. 1, use a qualified custodian, not an exchange, not a wallet, and definitely not your own keys. 2, stick to passive crypto holdings like Bitcoin, Ripple, Zcash, whatever altcoin. 3, avoid NFTs, most DeFi, staking, and lending. 4, don't invest in your own companies or your family's companies. And most importantly, talk to a CPA who actually understands both crypto and retirement taxes before you move money. So if you want to learn how to master crypto taxes, check out our course in Altcoin Pro. And if you want me to organize and plan for your crypto retirement, book a call. Links below. I just ask, if you hit $10 million in Bitcoin tax-free, please extend me an invite to your retirement party. To growing your wealth, I'm Anthony Price, CPA. See you in the next video.